What if I told you that the millions you are pouring into AI chips right now is going to absolutely zero because of a single broken physical wire? While retail crowds are manically chasing the NVDA rally, Wall Street has silently shifted the entire battlefield underneath your feet. The tech revolution is facing an invisible brick wall. It is not a software bug. It is not a chip shortage. It is a brutal systemic emergencies in the United States power grid that mainstream financial media is desperately trying to cover up. The billionaire whales are not buying the applications everyone is talking about. They are accumulating the assets that cool the servers and force power into the infrastructure. If you do not own the base layer, you are holding the bag. Period. Before we expose the dark pool data and tear down the exact 8 tickers institutions are accumulating, smash the subscribe button and lock into stock breakout. We do not do textbook education. We track actionable asymmetric alpha before the market reprices cold reality. Look at the CNBC smokescreen. Every single day, they parade academic analysts telling you to buy popular SaaS companies and expensive chip designers. But do not look at what they say. Look at the unusual whales flows and 13F filings from May 15th. The institutional smart money has spent the last 48 hours quietly liquidating overvalued software multiples. They're taking those billions in capital edging out of tech and dumping it directly into rugged, deep-value, capital-intensive monopolies in the American energy corridor. The obvious trap is thinking that AI is an exponential virtual reality platform. It is not. AI is a heavy industrial infrastructure beast that consumes extreme amounts of electricity. One single AI search request consumes 10 times more power than a standard Google search. By the time the total data center capacity doubles, the existing unprepared transformation grids will absolutely collapse under the speculative load. Wall Street knows this. They are preparing a huge shakedown, shutting retail out of the underlying utilities before the breakout. The hidden variable is the entire AI power stack. Narratives logically evolve in waves. First came the semiconductors. Then came the hyperscalers. But wave 3 is the raw revolution of copper constraints, high-voltage transformers, nuclear power purchase agreements, and liquid cooling systems. Why now? Why is this the absolute critical moment to reallocate your portfolio capital today? In the past 48 hours, regulators instigated reforms on reconstructing transmission lines. Meanwhile, major southern utilities just revised their 10-year data center capacity forecasts up by an astonishing percentage. The bottleneck is in real-time operations. You cannot build a billion-dollar generation capability in 2 weeks. Backlogs for critical electric utility infrastructure equipment, like industrial transformation core systems, have officially extended out beyond 4 full years. The orders are completely locked in. That means the revenue for these unglamorous monopolies is guaranteed regardless of a macroeconomic correction. Logical institutional whales are using the recent tech volatility as a mandatory shopping list in dark pools to secure enormous positions in these utility monopolies. Let us stop focusing on vague concepts and go directly to war with codes. We have analyzed 8 power stack tickers ranked strategically from the safest institutional protection proxies to the highest beta growing plays that can double YOU alpha capital. Coming in at number 8 is Nextra Energy, ticker NE. This is the absolute value floor for institutional conservatism. NE is the largest renewable utility proxy on Earth. When BlackRock and Vanguard need to allocate retail risk away from tech, they dump billions here. NE provides the enormous green footprint hyperscalers requiring clean power demand for carbon goals. It is not an explosive spec play. It is the unbreakable foundation. If the macro repricing crashes the Nasdaq, NE stands as an inflection-resistant capital castle. At number 7 is Southern Company, ticker SO. This is the systemic grid warrior accumulating massive data center inflows throughout the American Southeast. Southern recently brought new commercial nuclear reactors online, providing baseload reliability no standalone solar farm can match. The mainstream media despised SO during the years of construction delays. Wall Street capital exploited that fear to accumulate chips on the cheap. Now, Regulated returns are soaring as tech monopolies desperately bid up the energy off-take agreements in their regulated territory. Moving down the stack to critical component layers. Number 6 is Eaton Corporation, ticker ETN. Memorize this critical truth. Trucking power from a utility requires massive structural substations. Eaton absolutely dominates the global intellectual property patents for industrial power management and electrical control distribution switches. Their specific backlog is growing at an unprecedented pace. If a data center provider cannot buy electric equipment produced by Eaton, the millions spent on chips cannot power up. ETN is secure, high margin, and completely immune to small competitive price cuts. At number 5 is Quanta Services, ticker PWR. This is the industrial system workhorse force for grid modernization. Quanta Infrastructure constructs the massive physical transmission lines, expansive substations, and complex underground reconstruction pipelines, reconstructing the entire infrastructure system within North America. You can have the best design plan, but without Quanta equipment crews on the ground digging the trenches, nothing happens. Mainstream speculators constantly underestimate reconstruction engineering capital costs, allowing the smart money to suck up alpha before revenue inflections hit expectations. Now we enter the core bottleneck layer. Coming in at number 4 is GE Vernova, ticker GV. Spun out as a pure play infrastructure titan, GEV manages the heavy industrial wind and gas power turbines along with gridwork software solutions required to prevent blackouts. When hyperscalers realize solar is not enough for midnight LLM computing, they forcibly capitulate to natural gas power systems located next to infrastructure housing. GEV captures secure, high-margin, long-term services contracts that retail amateurs regularly overlook in valuations. Number 3 is the expensive but highly crowded name we must examine with severe caution, Vertiv Holdings, ticker VRT. Vertiv is the liquid cooling champion for AI chips. Reconstructing power density requires intense liquid thermal thermodynamics, unlike anything the industry has seen before. While Vertiv business fundamentals remain totally unbroken, the cold truth is that every single retail chaser on Twitter has finally discovered this ticker. At these valuation multiples, we strategically categorize VRT as a wait for pullback setup. Do not chase high momentum foolishly. We are entering the ultimate highest conviction choices of the entire revolution. Number 2 is Constellation Energy, ticker CEG. This is the preeminent nuclear revolution asymmetric bet on Wall Street. CG owns the utility intellectual infrastructure generating absolute baseload, decarbonized continuous atomic current from nuclear sites. When data center giants sign exclusive direct connection contracts with generation sites, bypassing regulated utilities entirely, CG captures incredible premium value spreads. Wall Street short sellers attack the initial deals, but intuitive whales know the raw power premium cannot be denied by regulators. Finally, armed with unmatched high-beta speculative power monopoly capacity, the number 1 position goes to Vistra Corp, ticker VSD. This is the absolute ultimate SPECO engine of the entire AI convergence infrastructure. VSD fuses massive regulated natural gas generation with aggressive, unregulated nuclear fleets. Vistra management capital allocation strategy is mercenary grade in performance. They buy back shares aggressively, while systematically reconstructing contract pricing with hyperscalers demanding direct off-take capability co-located at generation sites. It is high-risk, high-beta corridor to asymmetric wealth convergence. But hold your horses and execute a reality check now. As an institutional risk specialist, I will constantly remind you of one unwavering battlefield rule. A low stock price does not ever mean a cheap underlying value investment proposition. Assets require substantial balance sheet maintenance. These industrial capex monopolies carry massive structural debt thresholds. If interest rates remain severely reconstructed for longer realms, the interest expense can crush margin predictions quickly. You must demand stage-by-stage marginal security zones rather than chasing emotional breakout momentums coldly. Do not buy every ticker blindly. Split capital according to realistic profiles. Allocate fortress assets like NVDA as defensive portfolio-based structures, while saving high-momentum corridors like VSD for intentional tactical captures along explicit individual exponentially reconstructing sector support lines. Wall Street has trapped retail investors in the first wave trading vesicles while quietly accumulating the industrial infrastructure required for running the systems in extended durations. We discovered the cold pipeline capital rotations across dark pools long ago. The choice remains inherently yours. Are you going to continue buying overhyped tech chip multiples at dangerous revolution top climaxes? Or are you moving out to secure the infrastructure cornered by whales? Throw your conviction ticker in the comments right now. Watch stock breakout break down unfair games. Period.